Well, staying in that theme of building long-term resilient portfolios, climate change is an interesting challenge, right? It poses a significant number of risks. It also opens up a lot of interesting, compelling opportunities. So as we think about the companies that are poised to navigate a transition to a low carbon economy well, there are companies that have business lines focused on adaptive technologies, on transitioning to the use of renewables or development of alternative energies, to water filtration systems, companies that are producing energy efficient products. And so as we think about those sort of changing dynamics, certainly we can look at a challenge like climate change as a significant systemic risk, but we can also find really compelling investment opportunities that are poised to grow.
We do see emerging markets have been lagging behind developed markets in terms of their climate risk control, ESG framework, and acceptance of ESG investing. But that means this current disparity where we see potential investment opportunities. We see a positive outlook for companies already leading in ESG across emerging markets. They will have potential growth when policymakers catch up with regulation and favorable ESG frameworks. This is very hot topic, as Emily also mentioned. This is one of our focus in providing solutions to our clients. One of our capital market assumption themes for the next 5 years is staying focused on climate risk. We are seeing investors starting to look at climate risk with more urgency as the pandemic has made them more sensitive to how large non-financial events can hurt returns. We believe that climate risk will soon transition into market risk, most likely resulting in the considerable repricing of securities. Investors prepared for the storm are incorporating climate risk into their portfolio construction process, and stewardship activities to assess which companies are better positioned to transit to a low carbon economy. Using environmental criteria in the evaluation process is one way investors can help mitigate long-term climate risk. Taking our green transition strategy as an example, this strategy aims to cut down current and potential exposure to carbon emissions while minimizing exposure to carbon-related risks. To achieve this, the strategies exclude some of the highest carbon-intensive companies and aims to hedge climate risk by maximizing exposure to companies deriving revenue from green activities. Apart from this, we do see clients will require to be disclose their portfolio carbon exposure information. In order to better serve this type of client, we have developed different reports with indicators to monitor portfolio carbon reserve and also help them to keep track for the potential carbon emission in the portfolio.
We often talk about sustainability risks as long-term risks. And that is true, right? There are many long-term risks inherent associated with climate change and things of that nature. That said, certainly there are many near-term and mid-term risks associated with mismanaging material, environmental, social, and corporate governance issues. Again, if we take a cue from the COVID pandemic, we can see that many companies struggled to adapt quickly and effectively to managing human capital management issues, employee health and safety concerns, issues related to employee well-being, and topics like cybersecurity. And those are challenges that will continue to come up time and again. Certainly those are topics that we are focusing in on as part of our engagement priorities this year, to seek out ways to minimize those sorts of risks in the portfolio. So, from my perspective, sustainable investing does not automatically entail a compromise on performance. The focus here is certainly on running your due diligence and identifying a strategy that is aligned with targeting performance objectives, aligned with what the investor is seeking out. But there is a growing number of capabilities out there in the market that are focused on long-term value creation.
As long-term investors, we don't chase the latest fact. It's also important to take forward-looking and flexible approach to thoughtfully navigate the current market environment and investor goals. And we believe that a well-decided ESG strategy can help manage risk around dimensions of sustainability, such as climate risk, data security, and governance issues. The management of these non-financial risks, as well as controlling for sector deviations and stock-specific risks, can help. Taking this view, it can mean a more resilient portfolio. For example, in the first half of 2020, the sell-off generally has less hurt for ESG-focused strategies compared to non-ESG strategies, which could be partially due to the typical sector exposure of ESG strategies. Many ESG portfolios perform better overall relative to non-ESG peers. As mentioned earlier, we believe that the pairing of risk premium factors such as quality with ESG is important. This helps to identify companies engaging in longer-term strategic planning around ESG risks and opportunities, while maintaining financial health and delivering profitable results in high-quality companies. So we will see that means potentially excess return in the long run.